Open a ZERODHA account. Chapter 13. Moving Averages. We have all learned about averages in school. Moving average is just an extension of that. Moving averages are trend indicators and are frequently used due to their simplicity and effectiveness. Before we learn moving averages, let us have a quick recap on how averages are calculated. Assume 5 people are sitting on a nice sunny beach enjoying a nice chilled bottled beverage. The sun is so bright and nice that each one of them end up drinking several bottles of the beverage. Assume the final count to be something like this. SL no person know of bottles. 01A07. 02B05. 03C06. 04D03. 05E08. Total hash of bottles consumed 29. Assume a 6th person walks in to find out 29 bottles of beverages lying around them. He can quickly get a sense of roughly how many bottles each of them consumed by dividing the total number of bottles by total number of people. In this case it would be equals 29/5 equals 5.8 bottles per head. So, the average in this case tells us roughly how many bottles each person had consumed. Obviously, there would be few of them who had consumed above and below the average. For example, person E drank 8 bottles of beverage, which is way above the average of 5.8 bottles. Likewise, person D drank just 3 bottles of beverage, which is way below the average of 5.8 bottles. Therefore, average is just an estimate and one cannot expect it to be accurate. Extending the concept to stocks. Here are the closing prices of ITC Limited for the last 5 trading sessions. The last 5-day average close would be calculated as follows. Date closing price. The 14th of July 14,344.95. The 14th of July 15,342.35. The 14th of July 16,344.20. The 14th of July 17,344.25. The 14th of July 18,344.0. Total 1,179.75. Equals 1,179.755. Equals 343.95. Hence, the average closing price of ITC over the last 5 trading sessions is 343.95. 13.1 The moving average, also called the simple moving average. Consider a situation where you want to calculate the average closing price of Marico Limited for the latest 5 days. The data is as follows. Date closing price. The 14th of July 21, 239.2. The 14th of July 22, 240.6. The 14th of July 23, 241.8. The 14th of July 24, 242.8. The 14th of July 25, 247.9. Total 1,212.3. Equals 1,212.35. Equals 242.5. Hence, the average closing price of Marico over the last 5 trading sessions is 242.5. Moving forward. The next day, i.e. the 28th of July, 26th and 27th were Saturday and Sunday respectively. We have a new data point. This implies now the new latest 5 days would be 22nd, 23rd, 24th, 25th and 28th. We will drop the data point belonging to the 21st as our objective is to calculate the latest 5-day average. Date closing price. The 14th of July 22, 240.6. The 14th of July 23, 241.8. The 14th of July 24, 242.8. The 14th of July 25, 247.9. The 14th of July 28, 250.2. Total 1,223.3. Equals 1,223.35. Equals 244.66. Hence, the average closing price of Marico over the last 5 trading sessions is 244.66. As you can see, we have included the latest data, the 28th of July. and discarded the oldest data, the 21st of July, to calculate the 5-day average. On 29th, we would include 29th data and exclude 22nd data. On 30th, we would include 30th data point but eliminate 23rd data. So on and so forth. So essentially, we are moving to the latest data point and discarding the oldest to calculate the latest 5-day average. Hence the name, moving average. In the above example, the calculation of moving average is based on the closing prices. Sometimes, moving averages are also calculated using other parameters such as high, low, and open. However, the closing prices are used mostly by the traders and investors as it reflects the price at which the market finally settles down. Moving averages can be calculated for any time frame, from minutes, hours to years. Any time frame can be selected from the charting software based on your requirements. For those of you familiar with Excel, here is a screenshot of how moving averages are calculated on MS Excel. Notice how the cell reference moves in the average formula, eliminating the oldest to include the latest data points. Cell ref date close price 5-day average formula. D3 the 1st of January 14 1287.7. D4 the 2nd of January 14 1279.25. D5 the 3rd of January 14 1258.95. D6 the 6th of January 14 1249.7. D7 the 7th of January 14 1242.4. D8 the 8th of January 14 1268.75 1263.6 equals average. D3, D7. D9 the 9th of January 14 1231.2 1259.81 equals average. D4, D8. D10 the 14th of January 10 1201.75 1250.2 equals average. D5, D9. D11, the 14th of January 13 1159.2 1238.76 equals average. D6, D10. D12, the 14th of January 14 1157.25 1220.66 equals average. D7, D11. D13, the 14th of January 15 1141.35 1203.63 equals average. D8, D12. D14, the 14th of January 16 1152.5 1178.15 equals average. D9, D13. D15, the 14th of January 17 1139.6 1162.41 equals average. D10, D14. D16, the 14th of January 21,140.6 1149.98 equals average. D11, D15. D17, the 14th of January 21 1166.35 1146.26 equals average. D12, D16. D18, the 14th of January 22 1165.4 1148.08 equals average. D13, D17. D19, the 14th of January 23 1168.25 1152.89 equals average. D14, D18. As it is evident, the moving average changes as and when the closing price changes. A moving average is calculated above is called simple moving average, SMA. Since we are calculating it as per the latest 5 days of data, it is called referred to as 5-day SMA. The averages for the 5-day, or it could be anything like 5, 10, 50, 100, 200 days, are then joined to form a smooth curving line known as the moving average line. And it continues to move as the time progresses. In the chart shown below, I have overlaid a 5-day SMA over ACC's candlestick graph. So what does a moving average indicate and how does one use it? Well, there are many applications of moving average, and shortly I will introduce a simple trading system based on moving averages. But before that, let us learn about the exponential moving average. 13.2 The exponential moving average. Consider the data points used in this example. Date closing price. The 14th of July 22, 240.6. The 14th of July 23, 241.8. The 14th of July 24, 242.8. The 14th of July 25, 247.9. The 14th of July 28, 250.2. Total 1,214.5. When one calculates the average across these numbers, there is an unstated assumption. We are essentially giving each data point equal importance. Meaning, we are assuming that the data point on the 22nd of July is as important as the data point on the 28th of July. However, when it comes to markets, this may not always be true. Remember the basic assumption of technical analysis: markets discount everything. This means the latest price that you see on the 28th of July discounts all the known and unknown information. This also implies the price on 28th is more sacred than the price on 25th. Going by this, one would like to assign weightage to data points based on the newness of the data. Therefore, the data point on the 28th of July gets the highest weightage. The 25th of July gets the next highest weightage. The 24th of July gets the third highest. And so on. By doing so, I have essentially scaled the data points according to its newness. The latest data point gets the maximum attention and the oldest data point gets the least attention. The average calculated on this scaled set of numbers gives us the exponential moving average EMA. I deliberately skipped the EMA calculation part, simply because most of the technical analysis software lets us drag and drop the EMA on prices. Hence, we will focus on EMA's application as opposed to its calculation. Here is a chart of Supplementary Limited. I have plotted a 50-day SMA black and a 50-day EMA red on Supple's closing prices. Though both SMA and EMA are for a 50-day period, you can notice that the EMA is more reactive to the prices and hence it sticks closer to the price. The reason why EMA is quicker to react to the current market price is because EMA gives more importance to the most recent data points. This helps the trader to take quicker trading decisions. Hence, for this reason, traders prefer the use of the EMA over the SMA. 13.3 A simple application of moving average. The moving average can be used to identify buying and selling opportunities with its own merit. When the stock price trades above its average price, it means the traders are willing to buy the stock at a price higher than its average price. This means the traders are optimistic about the stock price going higher. Therefore, one should look at buying opportunities. Likewise, when the stock price trades below its average price, it means the traders are willing to sell the stock at a price lesser than its average price. This means the traders are pessimistic about the stock price movement. Therefore, one should look at selling opportunities. We can develop a simple trading system based on these conclusions. A trading system can be defined as a set of rules that help you identify entry and exit points. We will now try and define one such trading system based on a 50-day exponential moving average. Remember, a good trading system gives you a signal to enter a trade and a signal to close out the trade. We can define the moving average trading system with the following rules. Rule 1. Buy, go long, when the current market price turns greater than the 50-day EMA. Once you go long, you should stay invested till the necessary sell condition is satisfied. Rule 2. Exit the long position, square off, when the current market price turns lesser than the 50-day EMA. Here is a chart that shows the application of the trading system on Retracements. The black line on the price chart is the 50-day exponential moving average. Starting from left, the first opportunity to buy originated at 165. Highlighted on the charts as B1 at 165. Notice, at point B1, the stock price moved to a point higher than its 50-day EMA. Hence, as per the trading system rule, we initiate a fresh long position. Going by the trading system, we stay invested till we get an exit signal, which we eventually got at 187. Marked as S1 at 187. This trade generated a profit of 22 rupees per share. The next signal to go long came at B2 at 178, followed by a signal to square off at S2 at 182. This trade was not impressive as it resulted in a profit of just 4 rupees. However, the last trade, B3 at 165 and S3 at 215, was quite impressive, resulting in a profit of 50 rupees. Here is a quick summary of these trades based on the trading system fared. SL no buy price sell price gain loss percent return 01 165 187 22 13%, 02 178 182 04 2.2%, 03 165 215 50 30%. From the above table, it is very clear that the first and last trades were profitable, but the second trade was not so profitable. If you inspect why this happened, it is evident that during the first and the third trade, the stock was trending, but during the second trade the stock moved sideways. This leads us to a very important conclusion about the moving averages. Moving averages works brilliantly when there is a trend and fails to perform when the stock moves sideways. This basically means the moving average in its simplest form is a trend-following system. From my own personal experience of trading based on moving averages, I have noticed a few important characteristics. Moving averages gives you many trading signals buy and sell during a sideways market. Most of these signals result in marginal profits, if not for losses. However, usually one of those many trades results in a massive rally, like the B3 at 165 trade, leading to impressive gains. It would be very difficult to segregate the big winner from the many small trades. Hence, the trader should not be selective in terms of selecting signals that moving average system suggest. In fact, the trader should trade all the trades that the system suggests. Remember, the losses are minimum in a moving average system, but that one big trade is good enough to compensate all the losses and can give you sufficient profits. The profit-making trade ensures you are in the trend as long as the trend lasts, sometime even up to several months. For this reason, MA can be used as a proxy for identifying long-term investment ideas. The key to MA trading system is to take all the trades and not be judgmental about the signals being generated by the system. Here is another example of BPLC, where the MA system suggested multiple trades during the sideways market. However, none of them were really profitable. However, the last trade resulted in a 67% profit in about 5 months. 13.4 moving average crossover system. As it's evident now, the problem with the plain vanilla moving average system is that it generates far too many trading signals in a sideways market. A moving average crossover system is an improvisation over the plain vanilla moving average system. It helps the trader to take fewer trades in a sideways market. In a MA crossover system, instead of the usual single moving average, the trader combines two moving averages. This is usually referred to as smoothing. A typical example of this would be to combine a 50-day MA with a 100-day MA. The shorter moving average, 50 days in this case, is also referred to as the faster moving average. The longer moving average, 100 days moving average, is referred to as the slower moving average. The shorter moving average takes lesser number of data points to calculate the average, and hence it tends to stick closer to the current market price, and therefore reacts more quickly. A longer moving average takes more number of data points to calculate the average, and hence it tends to stay away from the current market price. Hence the reactions are slower. Here is the chart of Bank of Baroda, showing you how the two moving averages stack up when loaded on a chart. As you can see, the black 50-day MA line is closer to the current market price as it reacts faster when compared to the pink 100-day MA as it reacts slower. Traders have modified the plain vanilla MA system with the crossover system to smoothen out the entry and exit points. In the process, the trader gets far fewer signals, but the chances of the trade being profitable are quite high. The entry and exit rules for the crossover system is as stated below. Rule 1. Buy fresh long when the short-term moving averages turns greater than the long-term moving average. Stay in the trade as long as this condition is satisfied. Rule 2. Exit the long position. Square off when the short-term moving average turns lesser than the longer-term moving average. Let us apply the MA crossover system to the same VPCL example that we looked at. For ease of comparison, I have reproduced the BPCL's chart with a single 50-day MA. Notice, when the markets were moving sideways, MA suggested at least 3 trading signals. However, the fourth trade was the winner, which resulted in 67% profit. The chart shown below shows the application of AMA crossover system with 50 and 100-day EMA. The black line plots the 50-day moving average and the pink line plots the 100-day moving average. As per the crossover rule, the signal to go long originates when the 50-day moving average short-term MA crosses over the 100-day moving average long-term MA. The crossover point has been highlighted with an arrow. Please do notice how the crossover system keeps the trader away from the 3 unprofitable trades. This is the biggest advantage of a crossover system. A trader can use any combination to create a MA crossover system. Some of the popular combinations for a swing trader would be 9-day EMA with 21-day EMA. Use this for short-term trades up to a few trading session. 25-day EMA with 50-day EMA. Use this to identify medium-term trade up to a few weeks. 50-day EMA with 100-day EMA. Use this to identify trades that lasts up to a few months. 100-day EMA with 200-day EMA. Use this to identify long-term trades, investment opportunities. Some of them can even last for over a year or more. Remember, longer the time frame, the lesser the number of trading signals. Here is an example of a 25 by 50 EMA crossover. There are 3 trading signals that qualify under the crossover rule. Needless to say, the MA crossover system can also be applied for intraday trading. For instance, one could use the 15 by 30 minutes crossover to identify intraday opportunities. A more aggressive trader could use 5 by 10 minute crossover. You may have heard this popular saying in the markets, the trend is you, friend. Well, the moving averages help you identify this friend. Remember, MA is a trend following system. As long as there is a trend, the moving averages works brilliantly. It does not matter which time frame you use or which crossover combination you use. Key takeaways from this chapter. A standard average calculation is a quick approximation of a series of numbers. In an average calculation where the latest data is included and the oldest is excluded is called a moving average. The simple moving average, SMA, gives equal weightage to all data points in the series. An exponential moving average, EMA, scales the data according to its newness. Recent data gets the maximum weightage and the oldest gets the least weightage. For all practical purposes, use an EMA as opposed to SMA. This is because the EMA gives more weightage to the most recent data points. The outlook is bullish when the current market price is greater than the EMA. The outlook turns bearish when the current market price turns lesser than the EMA. In a non-trending market, moving averages may result in whipsaws, thereby causing frequent losses. To overcome this, a EMA crossover system is adopted. In a typical crossover system, the price chart is overlaid with 2 EMAs. The shorter EMA is faster to react, while the longer EMA is slower to react. The outlook turns bullish when the faster EMA crosses and is above the slower EMA. Hence, one should look at buying the stock. The trade lasts up to a point where the faster EMA starts going below the slower EMA. The longer the time frame one chooses for a crossover system, the lesser the trading signals. 259 responses to Open a ZERODHA account. Chapter 14. Indicators, Part 1. If you look at a stock chart displayed on a trader's trading terminal, you are most likely to see lines running all over the chart. These lines are called the technical indicators. A technical indicator helps a trader analyze the price movement of a security. Indicators are independent trading systems introduced to the world by successful traders. Indicators are built on preset logic using which traders can supplement their technical study candlesticks, volumes, S and R to arrive at a trading decision. Indicators help in buying, selling, confirming trends, and sometimes predicting trends. Indicators are of two types, namely leading and lagging. A leading indicator leads the price, meaning it usually signals the occurrence of a reversal or a new trend in advance. Well, this sounds interesting. You should note, not all leading indicators are accurate. Leading indicators are notorious for giving false signals. Therefore, the trader should be highly alert while using leading indicators. In fact, the efficiency of using leading indicators increases with trading experience. A majority of leading indicators are called oscillators as they oscillate within a bounded range. Typically, an oscillator oscillates between two extreme values, for example 0 to 100. Based on the oscillator's reading, for example 55, 70, etc., the trading interpretation varies. A lagging indicator, on the other hand, lags the price, meaning it usually signals the occurrence of a reversal or a new trend after it has occurred. You may think, what would be the use of getting a signal after the event has occurred? Well, it is better late than never. One of the most popular lagging indicators is the moving averages. You might be wondering if the moving average is an indicator in itself. Why, we discussed it even before we discussed the indicators formally. The reason is that moving averages is a core concept on its own. It finds its application within several indicators such as RSI, MACD, stochastic, etc. Hence, for this reason we discuss moving average as a standalone topic. Before we proceed further into understanding individual indicators, I think it is a good idea to understand what momentum means. Momentum is the rate at which the price changes. For example, if stock price is 100 rupees today and it moves to 105 rupees the next day, and 115 rupees the day after, we say the momentum is high as the stock price has changed by 15% in just 3 days. However, if the same 15% change happened over, let us say, 3 months, we can conclude the momentum is low. So the more rapidly the price changes, the higher the momentum. 14.1 Relative Strength Index. Relative Strength Index, or just RSI, is a very popular indicator developed by J. Wells Wilder. RSI is a leading momentum indicator which helps in identifying a trend reversal. RSI indicator oscillates between 0 and 100. And based on the latest indicator reading, the expectations on the markets are set. The term relative strength index can be a bit misleading as it does not compare the relative strength of two securities, but instead shows the internal strength of the security. RSI is the most popular leading indicator, which gives out strongest signals during the periods of sideways and non-trending ranges. The formula to calculate the RSI is as follows. Let us understand this indicator with the help of the following example. Assume the stock is trading at 99 on day 0. With this in perspective, consider the following data points. SL no closing price, points gained, points lost. 01 100 10. 02 102 20. 03 105 30. 04 107 20. 05 103 04. 06 100 03. 07 99 01. 08 97 02. 09 100 30. 10 105 50. 11 107 20. 12 110 30. 13 114 40. 14 118 40. Total 2910. In the above table, points gained lost denote the number of points gained lost with respect to the previous day close. For example, if today's close is 104 and yesterday's close was 100, points gained would be 4 and points lost would be 0. Similarly, if today's close was 104 and previous day's close was 107, the points gained would be 0 and points lost would be 3. Please note that the losses are computed as positive values. We have used 14 data points for the calculation, which is the default period setting in the charting software. This is also called the look-back period. If you are analyzing hourly charts, the default period is 14 hours. And if you are analyzing daily charts, the default period is 14 days. The first step is to calculate RS, also called the RSI factor. RS, as you can see in the formula, is the ratio of average points gained by the average points lost. Average points gained equals 29/14 equals 2.07. Average points lost equals 10/14 equals 0.714. RS equals 2.07, 0.714 equals 2.8991. Plugging in the value of RS in RSI formula equals 100, 1 plus 2.8991 equals 100, 100 thirds 0.8991 equals 100 to 25.6469. RSI equals 74.3531. As you can see, RSI calculation is fairly simple. The objective of using RSI is to help the trader identify oversold and overbought price areas. Overbought implies that the positive momentum in the stock is so high that it may not be sustainable for long, and hence there could be a correction. Likewise, an oversold position indicates that the negative momentum is high, leading to a possible reversal. Take a look at the chart of Supplementary Limited. You will find a lot of interesting developments. To begin with, the red line below the price chart indicates the 14-period RSI. If you notice the RSI scale, you will realize its upper bound to 100 and lower bound to 0. However, 100 and 0 are not visible in the chart. When the RSI reading is between 30 and 0, the security is supposed to be oversold and ready for an upward correction. When the security reading is between 70 and 100, the security is supposed to be heavily bought and is ready for a downward correction. The first vertical line marked from left shows a level where RSI is below 30. In fact, RSI is 26.8. Hence, RSI suggests that the stock is oversold. In this particular example, the RSI value of 26.8 also coincides with a bullish engulfing pattern. This gives the trader a double confirmation to go long. Needless to say, both volumes and S&R should also confirm to this. The second vertical line points to a level where the RSI turns 81, a value which is considered overbought. Hence, if not for looking at shorting opportunities, the trader should be careful in his decision to buy the stock. Again, if you notice the candles, they form a bearish engulfing pattern. So a bearish engulfing pattern, backed by an RSI of 81, is a sign to short the stock. What follows this is a quick and short correction in the stock. The example that I have shown here is quite nice, meaning both the candlestick pattern and RSI perfectly align to confirm the occurrence of the same event. This may not always be true. This leads us to another interesting way to interpret RSI. Imagine the following two scenarios. Scenario 1. A stock which is in a continuous uptrend. Remember, the uptrend can last from few days to few years. The RSI will remain stuck in the overbought region for a long time. And this is because the RSI is upper bound to 100. It cannot go beyond 100. Invariably, the trader would be looking at shorting opportunities, but the stock, on the other hand, will be in a different orbit. Example, Eicher Motors Limited. The stock has generated a return of close to 100% year-on-year. Scenario 2. A stock which is in a continuous downtrend. The RSI will be stuck in the oversold region. Since the RSI is lower bound to 0, it cannot go beyond 0. In this case as well, the trader will be looking at buying opportunities, but the stock will be going down lower. Example, Suzlon Energy. The stock has generated a return of negative 34% year-on-year. This leads us to interpret RSI in many different ways besides the classical interpretation, which we discussed earlier. If the RSI is fixed in an overbought region for a prolonged period, look for buying opportunities instead of shorting. The RSI stays in the overbought region for a prolonged period because of an excess positive momentum. If the RSI is fixed in an oversold region for a prolonged period, Look for selling opportunities rather than buying. RSI stays in the oversold region for a prolonged period because of an excess negative momentum. If the RSI value starts moving away from the oversold value after a prolonged period, look for buying opportunities. For example, the RSI moves above 30 after a long time may mean that the stock may have bottomed out. Hence a case of going long. If the RSI value starts moving away from the overbought value after a prolonged period, look for selling opportunities. For example, RSI moving below 70 after a long time. This means the stock may have topped out. Hence a case for shorting. 14.21 Last note. None of the parameters used while analyzing RSI should be treated with rigidity. For example, J. Wells Wilder opted to use a look-back period of 14 days simply because that was the value which gave the best results considering the market conditions in 1978, which is when RSI was introduced to the world. You may choose to use 5, 10, 20, or even 100 days look-back period if you wish to. In fact, this is how you develop your edge as a trader. You need to analyze what works for you and adopt the same. Please note, fewer the days you use to calculate the RSI, the more volatile the indicator would be. Also, J. Wells Wilder decided to use 0 to 30 level to indicate oversold regions and 70 to 100 level to indicate overbought region. Again, this is not set in stone. You can arrive at your own combination. I personally prefer to use 0 to 20 level and 80 to 100 level to identify oversold and overbought regions respectively. I use this along with the classical 14-day look-back period. Of course, I urge you to explore parameters that work for you. In fact, this is how you would eventually develop as a successful trader. Finally, do remember RSI is not used often as a standalone indicator by traders. It is used along with other candlestick patterns and indicators to study the market. Key takeaways from this chapter. Indicators are independent trading systems developed and introduced by successful traders. Indicators are leading or lagging. Leading indicators signals the possible occurrence of an event. Lagging indicators, on the other hand, confirms an ongoing trend. RSI is a momentum oscillator which oscillates between 0 and 100 level. A value between 0 and 30 is considered oversold. Hence the trader should look at buying opportunities. A value between 70 and 100 is considered overbought. Hence the trader should look at selling opportunities. If the RSI value is fixed in a region for a prolonged period, it indicates excess momentum, and hence instead of taking a reversed position, the trader can consider initiating a trade in the same direction. 110 Responses to Indicators, Part 1. By Mol. November 8th. Open a ZERODHA account. Chapter 15. Indicators, Part 2. 15.1 Moving Average Convergence and Divergence, MACD. The Moving Average Convergence and Divergence, MACD, indicator was developed by Gerald Apple in the late 70s. Traders consider MACD as the grand old daddy of indicators. Though invented in the 70s, MACD is still considered as one of the most reliable indicators by momentum traders. As the name implies, MACD is all about the convergence and divergence of the two moving averages. Convergence occurs when the two moving averages move towards each other, and a divergence occurs when the moving averages move away from each other. A standard MACD is calculated using a 12-day EMA and a 26-day EMA. From the 12-day EMA, the 26-day EMA is subtracted to extract the convergence and divergence CD value, also called the MACD line. Both the EMAs are based on the closing prices. Let us go through the math first and then figure out the applications of MACD. Date closed 12-day EMA, 26-day EMA, MACD line. The 1st of January 14, 6302. The 2nd of January 14, 6221. The 3rd of January 14, 6211. The 6th of January 14, 6191. The 7th of January 14, 6162. The 8th of January 14, 6175. The 9th of January 14, 6168. The 14th of January 10, 6171. The 14th of January 13, 6273. The 14th of January 14, 6242. The 14th of January 15, 6321. The 14th of January 16, 6319. The 14th of January 17, 6262, 6230. The 14th of January 26, 304, 6226. The 14th of January 21, 6314, 6233. The 14th of January 22, 6339, 6242. The 14th of January 23, 6346, 6254. The 14th of January 24, 6267, 6269. The 14th of January 27, 6136, 6277. The 14th of January 28, 6126, 6274. The 14th of January 29, 6120, 6271. The 14th of January 30, 6074, 6258. The 14th of January 31, 6090, 6244. The 3rd of February 14, 6002, 6225. The 4th of February 14, 6001, 6198. The 5th of February 14, 6022, 6176. The 6th of February 14, 6036, 6153, 6198, 45. The 7th of February 14, 6063, 6130, 6188, 58. The 14th of February 10, 6053, 6107, 6182, 75. The 14th of February 11, 6063, 6083, 6176, 94. The 14th of February 12, 6084, 6066, 6171, 106. The 14th of February 13, 6001, 6061, 6168, 107. Let us go through the table starting from left. We have the dates. Starting from the 1st of January 2014. Next to the dates we have the closing price of Nifty. We leave the first 12 data points closing price of Nifty to calculate the 12-day EMA. We then leave the first 26 data points to calculate the 26-day EMA. Once we have both 12 and 26-day EMA running parallel to each other, like on the 6th of February 2014, we calculate the MACD line. MACD line equals 12-day EMA, 26-day EMA. For example, on the 6th of February 2014, 12-day EMA was 6,153, and 26-day EMA was 6,198. Hence the MACD line would be 6153, 6198 equals 45. When we calculate the MACD line over a series of 12 and 26-day EMAs, we get an MACD line which oscillates above and below the central line. Date closed 12-day EMA, 26-day EMA MACD line. The 1st of January 14, 6302. The 2nd of January 14, 6221. The 3rd of January 14, 6211. The 6th of January 14, 6191. The 7th of January 14, 6162. The 8th of January 14, 6175. The 9th of January 14, 6168. The 14th of January 10, 6171. The 14th of January 13, 6273. The 14th of January 14, 6242. The 14th of January 15, 6321. The 14th of January 16, 6319. The 14th of January 17, 6262, 6230. The 14th of January 26, 304, 6226. The 14th of January 21, 6314, 6233. The 14th of January 22, 6339, 6242. The 14th of January 23 6346 6254. The 14th of January 24 6267 6269. The 14th of January 27 6136 6277. The 14th of January 28 6126 6274. The 14th of January 29 6120 6271. The 14th of January 30 6074 6258. The 14th of January 31 6090 6244. The 3rd of February 14 6002 6225. The 4th of February 14 6001 6198. The 5th of February 14 6022 6176. The 6th of February 14 6036 6153 6198 45. The 7th of February 14 6063 6130 6188 58. The 14th of February 10 6053 6107 6182 75. The 14th of February 11 6063 6083 6176 94. The 14th of February 12 6084 6066 6171 106. The 14th of February 13 6001 6061 6168 107. The 14th of February 14 6048 6051 6161 111. The 14th of February 17 6073 6045 6157 112. The 14th of February 18 6127 6045 6153 108. The 14th of February 19 6153 6048 6147 100. The 14th of February 26091 6060 6144 84. The 14th of February 21 6155 6068 6135 67. The 14th of February 24 6186 6079 6129 50. The 14th of February 25 6200 6092 6126 34. The 14th of February 26 6239 6103 6122 19. The 14th of February 28 6277 6118 6119 1. The 3rd of March 14 6221 6136 6117 20. The 4th of March 14 6298 6148 6112 36. The 5th of March 14 6329 6172 611359. The 6th of March 14 6401 6196 6121 75. The 7th of March 14 6527 6223 6131 92. The 14th of March 10 6537 6256 6147 110. The 14th of March 11 6512 6288 6165 124. The 14th of March 12 6517 6324 6181 143. The 14th of March 13 6493 6354 6201 153. The 14th of March 14 6504 6380 6220 160. There are a few questions that need to be answered. What does a negative MACD line indicate? What does a positive MACD line indicate? What does the magnitude of the MACD line actually mean? As in, what information does a minus 90 MACD line convey versus a 30 MACD line? The sign associated with the MACD line just indicates the direction of the stock's drift. For example, if the 12-day EMA is 6,380 and 26-day EMA is 6,220, then the MACD line is plus 160. Under what circumstance do you think the 12-day EMA will be greater than the 26-day EMA? Well, we had looked into this aspect in the moving average chapter. The shorter-term average will generally be higher than the longer-term only when the stock prices are trending upwards. Also, do remember, The shorter-term average will always be more reactive to the current market price than the longer-term average. Hence, a positive sign tells us that there is positive momentum in the stock, and the stock is drifting upwards. The higher the momentum, the higher is the magnitude. For example, plus 160 indicate a positive trend which is stronger than plus 120. However, while dealing with the magnitude, always remember the price of the stock influences the magnitude. For example, higher the underlying price such as Bank Nifty, naturally, the higher will be the magnitude of the MACD line. When the MACD line is negative, it means the 12-day EMA is lower than the 26-day EMA. Therefore the momentum is negative. Higher the magnitude of the MACD line, the more strength in the negative drift. The difference between the two moving averages is called the MACD spread. The spread decreases convergence when the momentum is dying, and increases divergence when the momentum is increasing. To visualize convergence and the divergence, traders usually plot the chart of the MACD line. The following is the MACD line chart of Nifty for data points starting from the 1st of January 2014 to 18th August 2014. As you can see, the MACD line oscillates over a central zero line. The basic interpretation of the MACD indicator is that when the MACD line crosses the zero line from the negative territory to positive territory, it means there is divergence between the two averages. This is a sign of increasing bullish momentum. Therefore, one should look at buying opportunities. From the chart above, we can see this panning out around the 27th of February. When the MACD line crosses the zero line from positive territory to the negative territory, it means there is convergence between the two averages. This is a sign of increasing bearish momentum. Therefore, one should look at selling opportunities. As you can see, there were two instances during which the MACD almost turned negative, the 8th of May and the 24th of July, but the MACD just stopped at the zero line and reversed directions. Critics argue that while a trader waits for the MACD line to cross over the zero line, a bulk of the move would have already transpired in the stock. To overcome this, there is an improvisation over this basic MACD line. The improvisation comes in the form of an additional MACD component, which is the 9-day signal line. A 9-day signal line is a simple moving average SMA of the MACD line. If you think about this, we now have two lines. A MACD line, a 9-day SMA of the MACD line, also called the signal line. With these two lines, a trader can follow a simple two-line crossover strategy as discussed in the moving averages chapter, and no longer wait for the zero-line crossover. The sentiment is bullish when the 9-day SMA crosses over the MACD line, wherein the 9-day SMA is greater than the MACD line. When this happens, the trader should look at buying opportunities. The sentiment is bearish when the 9-day SMA crosses over the MACD line, wherein the 9-day SMA is lesser than the MACD line. When this happens, the trader should look at selling opportunities. The chart below plots the MACD indicator on Asian Paints Limited. You can see the MACD indicator below the price chart. The indicator uses standard parameters of MACD, 12-day EMA of closing prices, 26-day EMA of closing prices. MACD line 12-day EMA, 26-day EMA represented by the black line. 9-day SMA of the MACD line represented by the red line. The vertical lines on the chart highlight the crossover points on the chart where a signal to either buy or sell has originated. For example, the first vertical line starting from left points to a crossover where the MACD signal 9-day SMA lies below the MACD line, and hence one should look for a selling opportunity. The second vertical line from left points to a crossover where the MACD signal line lies above the MACD line. Hence one should look at buying opportunity. Please note, at the core of the MACD system are moving averages. Hence the MACD indicator has similar properties like that of a moving average system. They work quite well when there is a strong trend and are not too useful when the markets are moving sideways. Needless to say, The MACD parameters are not set in stone. One is free to change the 12-day and 26-day EMA to whatever time frame one prefers. I personally like to use the MACD in its original form, as introduced by Gerald Apple. 15.2 The Bollinger Bands. Introduced by John Bollinger in the 1980s. Bollinger Bands BB is perhaps one of the most useful indicators used in technical analysis. BB are used to determine overbought and oversold levels, where a trader will try to sell when the price reaches the top of the band and will execute a buy when the price reaches the bottom of the band. The BB has three components. Middle line, which is the 20-day simple moving average of the closing prices. An upper band, this is the +2 standard deviation of the middle line. A lower band, this is the -2 standard deviation of the middle line. The standard deviation, SD, is a statistical concept which measures the variance of a particular variable from its average. In finance, the standard deviation of the stock price represents the volatility of a stock. For example, if the standard deviation of a stock is 12%, it is as good as saying that the volatility of the stock is 12%. In BB, the standard deviation is applied on the 20-day SMA. The upper band indicates the +2 SD. By using a +2 SD, we simply multiply the SD by 2 and add it to the average. For example, if the 20-day SMA is 7,800 and the SD is 75 or 0.96%, then the +2 SD would be 7,800 plus 75 asterisk 2 equals 7,950. Likewise, a -2 SD indicates we multiply the SD by 2 and subtract it from the average. 7,800 2 asterisk 75 equals 7,650. We now have the components of the BB. 20-day SMA equals 7,800. Upper band equals 7,950. Lower band equals 7,650. Statistically speaking, the current market price should hover around the average price of 7,800. However, if the current market price is around 7,950, then it is considered expensive with respect to the average. Hence, one should look at shorting opportunities with an expectation that the price will scale back to its average price. Therefore, the trade would be to sell at 7,950 with a target of 7,800. Likewise, if the current market price is around 7,650, it is considered cheap with respect to the average prices, and hence one should look at buying opportunities with an expectation that the prices will scale back to its average price. Therefore, the trade would be to buy at 7,650 with a target of 7,800. The upper and lower bands act as a trigger to initiate a trade. The following is the chart of BPCL Limited. The central black line is the 20-day SMA. The two red lines placed above and below the black line are the +2 SD and 2 SD. The idea is to short the stock when the price touches the upper band with an expectation that it will revert to average. Likewise, one can go long when the price touches the lower band with an expectation it will revert to the average. I have highlighted using a down arrow all of the sell signals BB generated. Well, most of the signals worked quite well. There was a phase when the price stuck to the upper band. In fact, the price continued to drift higher, and therefore even the upper band expanded. This is called an envelope expansion. The BB's upper and lower band together forms an envelope. The envelope expands whenever the price drifts in a particular direction, indicating a strong momentum. The BB signal fails when there is an envelope expansion. This leads us to an important conclusion. BB works well in sideways markets and fails in a trending market. Personally, whenever I use BB, I expect the trade to start working in my favor almost immediately. If it does not, I start validating the possibility of an envelope expansion. 15.3 Other indicators. There are numerous other technical indicators, and the list is endless. The question is, should you know all these indicators to be a successful trader? The answer is a simple no. Technical indicators are good to know, but they by no means should be your main tool of analysis. I have personally met many aspiring traders who spend a lot of time and energy learning different indicators, but this in the long run is futile. The working knowledge of few basic indicators, such as the ones discussed in this module, are sufficient. 15.4 The checklist. In the previous chapters, we started building a checklist that acts as a guiding force behind the trader's decision to buy or sell. It is time to revisit that checklist. The indicators act as tools which the traders can use to confirm their trading decisions. It is worthwhile to check what the indicators are conveying before placing a buy or a sell order. While the dependence on indicators is not as much as S&R volumes or candlestick patterns, it is always good to know what the basic indicators are suggesting. For this reason, I would recommend adding indicators in the checklist, but with a twist to it. I will explain the twist in a bit. But before that, let us reproduce the updated checklist. The stock should form a recognizable candlestick pattern. S&R should confirm to the trade. The stop-loss price should be around S&R. For a long trade, the low of the pattern should be around the support. For a short trade, the high of the pattern should be around the resistance. Volumes should confirm. Ensure above average volumes on both buy and sell day. Low volumes are not encouraging. Hence, do feel free to hesitate while taking trade where the volumes are low. Indicators should confirm. Scale the size higher if they confirm. If they don't confirm, go ahead with the original plan. The sub-bullet points under indicators are where the twist lies. Now, hypothetically imagine a situation where you are looking at opportunity to buy shares of Karnataka Bank Limited. On a particular day, Karnataka Bank has formed a bullish hammer. Assume everything ticks on the checklist. Bullish hammer is a recognizable candlestick pattern. The low of the bullish hammer also coincides with the support. The volumes are above average. There is also an MACD crossover signal line turns greater than the MACD line. With all four checklist points being ticked off, I would be very glad to buy Karnataka Bank. Hence I place an order to buy. Let us say for 500 shares. However, imagine a situation where the first three checklist conditions are met but the fourth condition, indicators should confirm, is not satisfied. What do you think I should do? I would still go ahead and buy. But instead of 500 shares, I'd probably buy 300 shares. This should hopefully convey to you how I tend to and advocate the use of indicators. When indicators confirm, I increase my bet size. But when indicators don't confirm, I still go ahead with my decision to buy. But I scale down my bet size. However, I would not do this with the first three checklist points. For example, if the low of the bullish hammer does not coincide in and around the support, then I'll really reconsider my plan to buy the stock. In fact, I may skip the opportunity and look for another opportunity. But I do not treat the indicators with the same conviction. It is always good to know what indicators convey, but I don't base my decisions on that. If the indicators confirm, I increase the bet size. If they don't, I still go ahead with my original game plan. Key takeaways from this chapter. MACD is a trend-following system. MACD consists of a 12-day, 26-day EMA. MACD line is 12D EMA, 26D EMA. Signal line is the 9-day SMA of the MACD line. A crossover strategy can be applied between MACD line and the signal line. The Bollinger Band captures the volatility. It has a 20-day average, a +2 SD, and a -2 SD. One can short when the current price is at +2 SD with an expectation that the price reverts to the average. One can go long when the current price is at 2 SD with an expectation that the price reverts to the average. BB works well in a sideways market. In a trending market, the BEB's envelope expands and generates many false signals. Indicators are good to know, but it should not be treated as the single source for decision-making. 168 Responses to Indicators, Part 2. Taki cannot access the selected text from this type of page. It is a very special page, and there are security limitations put in by the browser. You can also try to select text, then right-click on it, and choose Taki in the menu. I'm sorry for the inconvenience. Open a ZERODHA account. Chapter 16. The Fibonacci Retracements. The topic on Fibonacci retracements is quite intriguing. To fully understand and appreciate the concept of Fibonacci retracements, one must understand the Fibonacci series. The origins of the Fibonacci series can be traced back to the ancient Indian mathematics scripts, with some claims dating back to 200 BC. However, in the 12th century, Leonardo Pisano Bogolo, an Italian mathematician from Pisa, known to his friends as Fibonacci, discovered Fibonacci numbers. The Fibonacci series is a sequence of numbers starting from 0 arranged in such a way that the value of any number in the series is the sum of the previous two numbers. The Fibonacci sequence is as follows: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 377, 610. Notice the following. 233 equals 144 plus 89. 144 equals 89 plus 55. 89 equals 55 plus 34. Needless to say, the series extends to infinity. There are few interesting properties of the Fibonacci series. Divide any number in the series by the previous number. The ratio is always approximately 1.618. For example, 610 377 equals 1.618. 377 233 equals 1.618. 233 144 equals 1.618. The ratio of 1.618 is considered as the golden ratio, also referred to as the phi. Fibonacci numbers have their connection to nature. The ratio can be found in human face, flower petals, animal bodies, fruits, vegetables, rock formation, galaxial formations, etc. Of course, let us not get into this discussion as we would be digressing from the main topic. For those interested, I would suggest you search on the internet for golden ratio examples and you will be pleasantly surprised. Further into the ratio properties, one can find remarkable consistency when a number is in the Fibonacci series is divided by its immediate succeeding number. For example, 89 144 equals 0.618. 144 233 equals 0.618. 377 610 equals 0.618. At this stage, do bear in mind that 0.618, when expressed in percentage, is 61.8%. Similar consistency can be found when any number in the Fibonacci series is divided by a number 2 places higher. For example, 13 34 equals 0.382. 21 55 equals 0.382. 34 89 equals 0.382. 0.382 when expressed in percentage terms is 38.2%. Also, there is consistency when a number in the Fibonacci series is divided by a number 3 places higher. For example, 13 55 equals 0.236. 21 89 equals 0.236. 34 144 equals 0.236. 55 233 equals 0.236. 0.236 when expressed in percentage terms is 23.6%. 16.1 Relevance to stocks markets. It is believed that the Fibonacci ratios, i.e. 61.8%, 38.2%, and 23.6% finds its application in stock charts. Fibonacci analysis can be applied when there is a noticeable up move or down move in prices. Whenever the stock moves either upwards or downwards sharply, it usually tends to retrace back before its next move. For example, if the stock has run up from 50 rupees to 100 rupees, then it is likely to retrace back to probably 70 rupees before it can move 120 rupees. The retracement level forecast is a technique using which one can identify up to which level retracement can happen. These retracement levels provide a good opportunity for the traders to enter new positions in the direction of the trend. The Fibonacci ratios, i.e. 61.8%, 38.2%, and 23.6% helps the trader to identify the possible extent of the retracement. The trader can use these levels to position himself for trade. Have a look at the chart below. I've encircled 2 points on the chart. At 380 rupees where the stock started its rally, and at 489 rupees where the stock prices peaked. I would now define the move of 109, 380 to 489 as the Fibonacci up move, as per the Fibonacci retracement theory. After the up move, one can anticipate a correction in the stock to last up to the Fibonacci ratios. For example, the first level up to which the stock can correct could be 23.6%. If this stock continues to correct further, the trader can watch out for the 38.2% and 61.8% levels. Notice in the example shown below, the stock has retraced up to 61.8%, which coincides with 421.9, before it resumed the rally. We can arrive at 421 by using simple math as well. Total Fibonacci up move equals 109. 61.8% of Fibonacci up move equals 61.8% asterisk 109 equals 67.36. Retracement at 61.8% equals 489 to 67.36 equals 421.6. Likewise, we can calculate for 38.2% and the other ratios. However, one need not manually do this, as the software will do this for us. Here is another example where the chart has rallied from 288 rupees to 338 rupees. Therefore, 50 points move makes up for the Fibonacci up move. The stock retraced back 38.2% to 319 rupees before resuming its up move. The Fibonacci retracements can also be applied to stocks that are falling, in order to identify levels up to which the stock can bounce back. In the chart below, DLF Limited, the stock started to decline from 187 rupees to Rs. 120.6, thus making 67 points as the Fibonacci down move. After the down move, the stock attempted to bounce back, retracing back to 162 rupees, which is the 61.8% Fibonacci retracement level. 16.2 Fibonacci retracement construction. As we now know, Fibonacci retracements are movements in the chart that go against the trend. To use the Fibonacci retracements, we should first identify the 100% Fibonacci move. The 100% move can be an upward rally or a downward rally. To mark the 100% move, we need to pick the most recent peak and trough on the chart. Once this is identified, we connect them using a Fibonacci retracement tool. This is available in most of the technical analysis software packages, including Zeroda's Pi Slightly Smiling Face. Here is a step-by-step guide. Step 1. Identify the immediate peak and trough. In this case, the trough is at 150 and peak is at 240. The 90-point moves make it 100%. Step 2. Select the Fibonacci retracement tool from the chart tools. Step 3. Use the Fibonacci retracement tool to connect the trough and the peak. After selecting the Fibonacci retracement tool from the charts tool, the trader has to click on trough first, and without unclicking he has to drag the line till the peak. While doing this, Simultaneously, the Fibonacci retracements level starts getting plotted on the chart. However, the software completes the retracement identification process only after you finish selecting both the trough and the peak. This is how the chart looks after selecting both the points. You can now see the Fibonacci retracement levels are calculated and loaded on the chart. Use this information to position yourself in the market. 16.3 How should you use the Fibonacci retracement levels? Think of a situation where you wanted to buy a particular stock but you have not been able to do so because of a sharp run-up in the stock. In such a situation, the most prudent action to take would be to wait for a retracement in the stock. Fibonacci retracement levels such as 61.8%, 38.2%, and 23.6% act as a potential level up to which a stock can correct. By plotting the Fibonacci retracement levels, the trader can identify these retracement levels and therefore position himself for an opportunity to enter the trade. However, please note, like any indicator, use the Fibonacci retracement as a confirmation tool. I would buy a stock only after it has passed the other checklist items. In other words, my conviction to buy would be higher if the stock has formed a recognizable candlestick pattern. The stop loss coincides with the S&R level. Volumes are above average, along with the above points. If the stop loss also coincides with the Fibonacci level, then I know the trade setup is well aligned to all the variables and hence I would go in for a strong buy. The usage of the word strong just indicates the level of conviction in the trade setup. The more confirming factors we use to study the trend and reversal, more robust is the signal. The same logic can also be applied for the short trade. Key takeaways from this chapter. The Fibonacci series forms the basis for Fibonacci retracement. A Fibonacci series has many mathematical properties. These mathematical properties are prevalent in many aspects of nature. Traders believe the Fibonacci series has its application in stock charts as it identified potential retracement levels. Fibonacci retracements are levels 61.8%, 38.2%, and 23.6% up to which a stock can possibly retrace before it resumes the original directional move. At the Fibonacci retracement level, the trader can look at initiating a new trade. However, before initiating the trade, other points in the checklist should also confirm 131 responses to the Fibonacci retracements. Open a ZERODHA account. Chapter 17. The Dow Theory, Part 1. The Dow theory has always been a very integral part of technical analysis. The Dow theory was used extensively even before the Western world discovered candlesticks. In fact, even today Dow theory concepts are being used. In fact, traders blend the best practices from candlesticks and Dow theory. The Dow theory was introduced to the world by Charles H. Dow, who also founded the Dow Jones Financial News Service, Wall Street Journal. During his time, he wrote a series of articles starting from 1900s which in the later years was referred to as the Dow theory. Much credit goes to William P. Hamilton, who compiled these articles with relevant examples over a period of 27 years. Much has changed since the time of Charles Dow, and hence there are supporters and critics of the Dow theory. 17.1 The Dow theory principles. The Dow theory is built on a few beliefs. These are called the Dow theory tenets. These tenets were developed by Charles H. Dow over the years of his observation on the markets. There are 9 tenets that are considered as the guiding force behind the Dow theory. They are as follows. No tenet. What does it mean? 1. Indices discounts everything. The stock market indices discount everything which is known and unknown in the public domain. If a sudden and unexpected event occurs, the stock market indices quickly recalibrates itself to reflect the accurate value. 2. Overall, there are 3 broad market trends: primary trend, secondary trend, and minor trends. 03. The primary trend. This is the major trend of the market that lasts from a year to several years. It indicates the broader multi-year direction of the market. While the long-term investor is interested in the primary trend, an active trader is interested in all trends. The primary trend could be a primary uptrend or a primary downtrend. 04. The secondary trend. These are corrections to the primary trend. Think of this as a minor counter-reaction to the larger movement in the market. Example, corrections in the bull market, rallies and recoveries in the bear market. The counter-trend can last anywhere between a few weeks to several months. 05. Minor trends, daily fluctuations. These are daily fluctuations in the market. Some traders prefer to call them market noise. 06. All indices must confirm with each other. We cannot confirm a trend based on just one index. For example, the market is said to be bullish only if CNX Nifty, CNX Nifty Mid Cap, CNX Nifty Small Cap, etc. all move in the same upward direction. It would not be possible to classify markets as bullish just by the action of CNX Nifty alone. 07. Volumes must confirm. The volumes must confirm along with price. The trend should be supported by volume. In an uptrend, the volume must increase as the price rises and should reduce as the price falls. In a downtrend, volume must increase when the price falls and decrease when the price rises. You could refer Chapter 12 for more details on volume. 08. Sideways markets can substitute secondary markets. Markets may remain sideways, trading between a range for an extended period. Example, Reliance Industries between 2010 and 2013 was trading between 860 and 990. The sideways markets can be a substitute for a secondary trend. 09. The closing price is the most sacred between the open, high, low and close prices. The close is the most important price level as it represents the final evaluation of the stock during the day. 17.2. The different phases of market. Dow theory suggests the markets are made up of three distinct phases, which are self-repeating. These are called the accumulation phase, the markup phase, and the distribution phase. The accumulation phase usually occurs right after a steep sell-off in the market. The steep sell-off in the markets would have frustrated many market participants, losing hope of any sort of uptrend in prices. The stock prices would have plummeted to rock-bottom valuations. But the buyers would still be hesitant of buying, fearing there could be another sell-off. Hence the stock price languishes at low levels. This is when the smart money enters the market. Smart money is usually the institutional investors who invest from a long-term perspective. They invariably seek value investments, which is available after a steep sell-off. Institutional investors start to acquire shares regularly, in large quantities over an extended period of time. This is what makes up an accumulation phase. This also means that the sellers who are trying to sell during the accumulation phase will easily find buyers, and therefore the prices do not decline further. Hence, invariably the accumulation phase marks the bottom of the markets. More often than not, this is how the support levels are created. Accumulation phase can last up to several months. Once the institutional investors, smart money, absorb all the available stocks, short-term traders sense the occurrence of a support. This usually coincides with improved business sentiment. These factors tend to take the stock price higher. This is called the markup phase. During the markup phase, the stock price rallies quickly and sharply. The most important feature of the markup phase is the speed. Because the rally is quick, the public at large is left out of the rally. New investors are mesmerized by the return, and everyone from the analysts to the public see higher levels ahead. Finally, when the stock price reaches new highs, 52-week high, all-time high, everyone around would be talking about the stock market. The news reports turn optimistic. Business environment suddenly appears vibrant, and everyone, public, wants to invest in the markets. The public, by and large, wants to get involved in the markets as there is a positive sentiment. This is when the distribution phase occurs. The judicious investors, smart investors who got in early during the accumulation phase will start offloading their shares slowly. The public will absorb all the volumes offloaded by the institutional investors, smart money, thereby giving them the well-needed price support. The distribution phase has similar price properties as that of the accumulation phase. In the distribution phase, whenever the prices attempt to go higher, the smart money offloads their holdings. Over a period of time, this action repeats several times and thus the resistance level is created. Finally, when the institutional investors, smart money, completely sell off their holdings, there would no further support for prices. And hence what follows after the distribution phase is a complete sell-off in the markets, also known as the markdown of prices. The sell-off in the market leaves the public in an utter state of frustration. Completing the circle, what follows the sell-off phase is a fresh round of accumulation phase. And the whole cycle repeats again. It is believed that that entire cycle from accumulation phase to the sell-off spans over a few years. It is important to note that no two market cycles are the same. For example, in the Indian context, the bull market of 2006-07 is way different from the bull market of 2013-14. Sometimes the market moves from the accumulation to the distribution phase over a prolonged, multi-year period. On the other hand, the same move from the accumulation to the distribution can happen over a few months. The market participant needs to tune himself to the idea of evaluating markets in the context of different phases, as this sets a stage for developing a view on the market. 17.3 The Dow Patterns. Like in candlesticks, there are a few important patterns in Dow theory as well. The trader can use these patterns to identify trading opportunities. Some of the patterns that we will study are the double bottom and double top formation, the triple bottom and triple top, range formation, and flag formation. The support and resistance is also a core concept for the Dow theory. But because of its importance in terms of placing targets and stop loss, we have discussed it much. Earlier a chapter dedicated to it. 17.4 The double bottom and top formation. A double top and double bottom is considered a reversal pattern. A double bottom occurs when the price of a stock hits a particular low price level and rebounds back with a quick recovery. Following the price recovery, the stock trades at a higher level relative to the low price for at least 2 weeks, well spaced in time, after which the stock attempts to hit back to the low price previously made. If the stock holds up once again and rebounds, then a double bottom is formed. A double bottom formation is considered bullish, and hence one should look at buying opportunities. Here is a chart that shows a double bottom formation in Supplementary Limited. Notice the time interval between the two bottom formations. It is evident that the price level was well spaced in time. Likewise, in a double top formation, the stock attempts to hit the same high price twice but eventually sells off. Of course, the time gap between the two attempts of crossing the high should at least be 2 weeks. In the chart below, Cairn India Limited, we can notice the double top at 336 levels. On close observation, you will notice the first top was around 336 rupees, and the second top was around 332 rupees. With some amount of flexibility, a small difference such as this should be considered alright. From my own trading experience, I find both double tops and double bottoms very useful while trading. I always look for opportunities where the double formation coincides with a recognizable candlesticks formation. For instance, imagine a situation wherein the double top formation, the second top forms a bearish pattern such as shooting star. This means, both from the Dow theory and candlestick perspective, there is consensus to sell. Hence the conviction to take the trade is higher. 17.5 The triple top and bottom. As you may have guessed, a triple formation is similar to a double formation, except that the price level is tested thrice as opposed twice in a double bottom. The interpretation of the triple formation is similar to the double formation. As a rule of thumb, the more number of times the price tests and reacts to a certain price level, the more sacred the price level is considered. Therefore, by virtue of this, the triple formation is considered more powerful than the double formation. The following chart shows a triple top formation for DLF Limited. Notice the sharp sell-off after testing the price level for the third time, thus completing the triple top. Key takeaways from this chapter. Dow theory was used in the Western world even before candlesticks were formally introduced. Dow theory works on 9 basic tenets. Market can be viewed in 3 basic phases: accumulation, markup, and distribution phase. The accumulation phase is when the institutional investor, smart money, enters the market. Markup phase is when traders make an entry. And the final distribution phase is when the larger public enter the market. What follows the distribution phase is the markdown phase, following which the accumulation phase will complete the circle. The Dow theory has a few basic patterns, which are best used in conjunction with candlesticks. The double and triple formations are reversal patterns, which are quite effective. The interpretation of double and triple formations are the same. 59 responses to The Dow Theory, Part 1. Johar, November 14, 2014 at 11:15 a.m. Please correct typo at 7. Open a ZERODHA account. Chapter 18. The Dow Theory, Part 2. 18.1 Trading Range. The concept of range is a natural extension to the double and triple formation. In a range, the stock attempts to hit the same upper and lower price level multiple times for an extended period of time. This is also referred to as the sideways market, as the price oscillates in a narrow range without forming a particular trend. It is called a sideways market or sideways drift. So, when both the buyers and sellers are not confident about the market direction, the price would typically move in a range. And hence typical long-term investors would find the markets a bit frustrating during this period. However, the range provides multiple opportunities to trade both ways, long and short, with reasonable accuracy for a short-term trader. The upside is capped by resistance and the downside by the support. Thus it is known as a range-bound market or a trading market, as there are enough opportunities for both the buyers and the sellers. In the chart below you can see the stock's behavior in a typical range. As you can see, the stock hit the same upper 165 rupees and the same lower 128 rupees level multiple times, and continued to trade within the range. The area between the upper and lower level is called the width of the range. One of the easy trades to initiate in such a scenario would be to buy near the lower level and sell near the higher level. In fact, the trade can be both ways, with the trader opting to short at the higher level and buying it back at the lower level. In fact, the chart above is a classic example of blending Dow theory with candlestick patterns. Starting from left, notice the encircled candles. The bullish engulfing pattern is suggesting a long. Morning doji star suggesting a long. Bearish engulfing pattern is suggesting a short. Bearish harami pattern is suggesting a short. The short-term trader should not miss out such trades, as these are easy to identify trading opportunities with high probability of being profitable. The duration of the range can be anywhere between a few weeks to a couple of years. The longer the duration of the range, the longer is the width of the range. 18.2 The range breakout. Stocks do break out of the range after being in the range for a long time. Before we explore this, it is interesting to understand why stocks trade in the range in the first place. Stocks can trade in the range for 2 reasons. When there are no meaningful fundamental triggers that can move the stock, these triggers are usually quarterly, annual result announcement, new products launches, new geographic expansions, change in management, joint ventures, mergers, acquisitions, etc. When there is nothing exciting or nothing bad about the company, the stock tends to trade in a trading range. The range under these circumstances could be quite long-lasting until a meaningful trigger occurs. In anticipation of a big announcement, when market anticipates a big corporate announcement, the stock can swing in either directions based on the outcome of the announcement. Till the announcement is made, both buyers and sellers would be hesitant to take action, and hence the stock gets into the range. The range under such circumstances can be short-lived, lasting until the announcement event is made. The stock, after being in the range, can break out of the range. The range breakout more often than not indicates the start of a new trend. The direction in which the stock will break out depends on the nature of the trigger or the outcome of the event. What is more important is the breakout itself and the trading opportunity it provides. A trader will take a long position when the stock price breaks the resistance levels and will go short after the stock price breaks the support level. Think of the range as an enclosed compression chamber where the pressure builds up on each passing day. With a small vent, the pressure eases out with a great force. This is how the breakout happens. However, the trader needs to be aware of the concept of a false breakout. A false breakout happens when the trigger is not strong enough to pull the stock in a particular direction. Loosely put, a false breakout happens when not so trigger-friendly event occurs and impatient retail market participants react to it. Usually the volumes are low on false range breakouts, indicating there is no smart money involved in the move. After a false breakout, the stock usually falls back within the range. A true breakout has two distinct characteristics. Volumes are high and, after the breakout, the momentum rate of change of price is high. Have a look at the chart below. The stock attempted to break out of the range 3 times. However, the first 2 attempts were false breakouts. The first breakout, starting from left, was characterized by low volumes and low momentum. The second breakout was characterized by impressive volumes but lacked momentum. However, the third breakout had the classic breakout attributes, i.e. high volumes and high momentum. 18.3 Trading the range breakout. Traders buy the stock as soon as the stock breaks out of the range on good volumes. Good volumes confirm just one of the prerequisites of the range breakout. However, there is no way for the trader to figure out if the momentum, second prerequisite, will continue to build. Hence, the trader should always have a stop loss for range breakout trades. For example, assume the stock is trading in a range between 128 rupees and 165 rupees. The stock breaks out of the range and surges above 165 rupees and now trades at 170 rupees. Then trader would be advised to go long 170 and place a stop loss at 165 rupees. Alternatively, assume the stock breaks out at 128 rupees, also called the breakdown, and trades at 123 rupees. The trader can initiate a short trade at 123 rupees and treat the level of 128 rupees as the stop loss level. After initiating the trade, if the breakout is genuine, then the trader can expect a move in the stock which is at least equivalent to the width of the range. For example, with the breakout at 168 rupees, the minimum target expectation would be 43 points since the width is 168 to 125 equals 43. This translates to a price target of 168 rupees plus 43 equals 211. 18.4 The flag formation. The flag formation usually takes place when the stock posts a sustained rally with almost a vertical or a steep increase in stock prices. Flag patterns are marked by a big move which is followed by a short correction. In the correction phase, the price would generally move within 2 parallel lines. Flag pattern takes the shape of a parallelogram or a rectangle and they have the appearance of a flag on the pole. The price decline can last anywhere between 5 and 15 trading sessions. With these 2 events, i.e. price rally and price decline, occurring consecutively, a flag formation is formed. When a flag forms, the stock invariably spurts back all of a sudden and continues to rally upwards. For a trader who has missed the opportunity to buy the stock, the flag formation offers a second chance to buy. However, the trader has to be quick in taking the position as the stock tends to move up all of a sudden. In the chart above, the sudden upward move is quite evident. The logic behind the flag formation is fairly simple. The steep rally in the stock offers an opportunity for market participants to book profits. Invariably, the retail participants who are happy with the recent gains in the stock start booking profits by selling the stock. This leads to a decline in the stock price, as only the retail participants are selling. The volumes are on the lower side. The smart money is still invested in the stock, and hence the sentiment is positive for the stock. Many traders see this as an opportunity to buy the stock and hence the price rallies all of a sudden. 18.5 The reward to risk ratio, RRR. The concept of reward to risk ratio, RRR, is generic and not really specific to Dow theory. It would have been apt to discuss this under trading systems and risk management. However, RRR finds its application across every type of trading, be it trades based on technical analysis or investments through fundamentals. For this reason, we will discuss the concept of RRR here. The calculation of the reward to risk ratio is very simple. Look at the details of this short-term long trade. Entry: 55.75. Stop loss: 53.55. Expected target: 57.20. On the face of it, considering it as a short-term trade, the trade looks alright. However, let us inspect this further. What is the risk the trader is taking? Entry: stop loss, i.e. 55.75 to 53.55 equals 2.2. What is the reward the trader is expecting? Exit: entry, i.e. 57.2 to 55.75 equals 1.45. This means for a reward of 1.45 points the trader is risking 2.2 points, or in other words the reward to risk ratio is 1.45. 2.2 equals 0.65. Clearly this is not a great trade. A good trade should be characterized by a rich RRR. In other words, for every 1 rupee per you risk on a trade, your expected return should be at least 1 rupee and 30 paise per higher. Otherwise it is simply not worth the risk. For example, consider this long trade. Entry: 107. Stop loss: 102. Expected target: 114. In this trade the trader is risking 5 rupees per 107 to 102 for an expected reward of 7 rupees per 114 to 107. RRR in this case is 7/5 equals 1.4. This means for every 1 rupee per of risk the trader is assuming, he is expecting 1 rupee and 40 paise as reward. Not a bad deal. The minimum RRR threshold should be set by each trader based on his/her risk appetite. For instance, I personally don't like to take up trades with a RRR of less than 1.5. Some aggressive traders don't mind a RRR of 1. Meaning for every 1 rupee they risk they expect a reward of 1 rupee. Some would prefer the RRR to be at least 1.25. Ultra-cautious traders would prefer their RRR to be upwards of 2. Meaning for every 1 rupee per of risk they would expect at least 2 rupees as reward. A trade must qualify the trader's RRR requirement. Remember, a low RRR is just not worth the trade. Ultimately, if RRR is not satisfied, then even a trade that looks attractive must be dropped as it is just not worth the risk. To give you a perspective thinking about this hypothetical situation, a bearish engulfing pattern has been formed right at the top end of a trade. The point at which the bearish engulfing pattern has formed also marks a double top formation. The volumes are very attractive as they are at least 30% more than the 10-day average volumes. Near the bearish engulfing pattern's high, the chart is showing a medium-term support. In the above situation, everything seems perfectly aligned to short trade. Assume the trade details are as below. Entry: 765.67. Stop loss: 772.85. Target: 758.5. Risk: 7.18, 772.85 to 765.67, i.e. stop loss. Entry: reward: 7.17, 765.67 to 758.5, i.e. entry. Exit: RRR: 7.17, 7.18 equals approximately 1.0. As I mentioned earlier, I do have a stringent RRR requirement of at least 1.5. For this reason, even though the trade above looks great, I would be happy to drop it and move on to scout the next opportunity. As you may have guessed by now, RRR finds a spot in the checklist. 18.6 The Grand Checklist. Having covered all the important aspects of technical analysis, we now need to look at the checklist again and finalize it. As you may have guessed, Dow theory obviously finds a place in the checklist as it provides another round of confirmation to initiate the trade. The stock should form a recognizable candlestick pattern. S&R should confirm to the trade. The stop-loss price should be around S&R. For a long trade, the low of the pattern should be around the support. For a short trade, the high of the pattern should be around the resistance. Volumes should confirm. Ensure above average volumes on both buy and sell day. Low volumes are not encouraging, and hence do feel free to hesitate while taking trade where the volumes are low. Look at the trade from the Dow theory perspective. Primary, secondary trends, double, triple, range formations, recognizable Dow formation. Indicators should confirm. Scale the trade size higher if indicators confirm to your plan of action. If the indicators do not confirm, go ahead with the original plan. RRR should be satisfactory. Think about your risk appetite and identify your RRR threshold. For a complete beginner, I would suggest the RRR to be as high as possible, as this provides a margin of safety. For an active trader, I would suggest a RRR of at least 1.5. When you identify a trading opportunity, always look how the trade is positioned from the Dow theory perspective. For example, if you are considering a long trade based on candlesticks, then look at what the primary and secondary trend is suggesting. If the primary trend is bullish, then it would be a good sign. However, if we are in the secondary trend, which is counter to the primary, then you may want to think twice, as the immediate trend is counter to the long trade. If you follow the checklist mentioned above and completely understand its importance, I can assure you that your trading will improve multiple folds. So the next time you take a trade, ensure you comply with above checklist. If not for anything, at least you will have no reason to initiate a trade based on loose and unscientific logic. 18.7 What next? We have covered many aspects of technical analysis in this module. I can assure you the topics covered here are good enough to put you on a strong platform. You may believe there is a need to explore other patterns and indicators that we have not discussed here. If we have not discussed a pattern or an indicator here on Varsity, do remember it is for a specific purpose. So be assured that you have all that you need to begin your journey with technical analysis. If you can devote time to understanding each one of these topics thoroughly, then you can be certain about developing a strong top-based thinking framework. The next logical progression from here would be to explore ideas behind backtesting trading strategies, risk management, and trading psychology, all of which we will cover in the subsequent modules. In the next concluding chapter, we will discuss few practical aspects that will help you get started with technical analysis. Key takeaways from this chapter. A range is formed when the stock oscillates between the two price points. A trader can buy at the lower price point and sell at the higher price point. The stock gets into a range for a specific reason, such as the lack of fundamental triggers or event expectation. The stock can break out of the range. A good breakout is characterized by above average volumes and sharp surge in prices. If the trader has missed an opportunity to buy a stock, the flag formation offers another window to buy. RRR is a critical parameter for trade evaluation. Develop a minimum RRR threshold based on your risk appetite. Before initiating a trade, the trader should look at the opportunity from the Dow theory perspective. 74 responses to the Dow. Open a ZERODHA account. Chapter 19. The finale, helping you get started. 19.1 The charting software. Over the last 18 chapters we have learned many aspects of technical analysis. If you have read through all the chapters and understood what is being discussed, You are certainly at a stage where you can start trading based on technical analysis. The objective of this chapter is to help you get started with identifying technical trading opportunities. Kindly note, the suggestions I have put forth in this chapter are based on my trading experience. To begin with, you need a chart visualization software, simply called the charting software. The charting software helps you look at the various stock charts and analyze the same. Needless to say, the charting software is a very important tool for a technical analyst. There are many charting softwares available. The two most popular ones are Metastock and AmaBroker. Majority of the technical analysts use one of the two charting softwares. Needless to say, these are paid softwares and you need to purchase the software license before using it. There are a few online free charting tools that are available which you can use. These are available on Yahoo Finance, Google Finance, and pretty much all the business media websites. However, my advice to you is, if you aspire to become a technical analyst, get access to a good charting software. Think of the charting software as a DVD player. Once you have a DVD player installed, you will still need to rent DVDs to watch movies. Similarly, once you have a charting software installed, you will still need to feed it with data to actually view the charts. The data feed required is provided by the data vendors. There are many data vendors in India giving you access to data feeds. I would suggest you look up on the internet for reliable vendors. You just need to inform the data vendor which charting software you have, and he will provide you the data feeds in a format that is compatible with your charting software. Of course, the data feeds come at a cost. Once you sign up with a data vendor, he will first give you all the historical data, after which you will have to update the data from his server on a daily basis to stay current. From my experience buying the latest version of a good charting software, Metastock or AmaBroker, can cost you a one-time fee of anywhere between 25,000 rupees per and 30,000 rupees per. Add to this another 15,000 rupees per to 25,000 rupees towards the data feeds. Of course, while the software cost is one time, the cost of data feeds recurs annually. Denote, the older versions of the charting software may cost you much lesser. Now, if you are in no mood to spend so much for the charting software and data feed combination, there is another alternative, and that would be Zeroda's Pi. As you may know, Zeroda has a proprietary trading terminal called Pi. Pi helps you in many ways. I would like to draw your attention to some of its features in the context of technical analysis. It is bundled. Pi is a charting software and a data feed package bundled into a single software. Great visualizations. Pi helps you visualize charts across multiple time frames including intraday charts. Advanced features. Pi has advanced charting features and includes 80 built-in technical indicators and over 30 drawing tools. Scripting use strategy. Pi has a scripting language employing which you can code technical strategies and backtest the same on historical data. Denote, on Varsity we will soon include a module on building trading strategies and scripting. Easy opportunity recognition. Pi has pattern recognition feature that lets you draw a pattern on the screen. Once you draw, just command Pi to scout for that pattern across the market and it will do just that for you. Trade from Pi. Pi also lets you execute trades directly from the chart, a huge plus point for a technical trader. Data dump. Pi has a massive historical data dump, over 50,000 candles, which means backtesting your strategy will be more efficient. Your personal trading assistant. Pi's expert advisor keeps you informed about the patterns being developed in the live markets. Super advanced features. Pi has artificial intelligence and genetic algorithms. These are optimization tools which helps you optimize your trading algorithms. It is free. Zeroda is giving it free of cost to all its active traders. The list is quite exhaustive, ranging from the basic to advanced features. I would strongly suggest you try out Pi before you decide to venture out for charting package and data feed bundle. 19.2 Which time frame to choose? We discussed time frames in Chapter 3. I would request you to read through it again to refresh your memory. Selecting the time frame while scanning for trading opportunities is perhaps one of the biggest confusion a newbie technical analyst has. There are many time frames you can choose from: 1 minute, 5 minutes, 10 minutes, 15 minutes, EOD, weekly, monthly, and yearly. It is quite easy to get confused with this. As a thumb rule, the higher the time frame, the more reliable the trading signal is. For example, a bullish engulfing pattern on the 15-minute time frame is far more reliable than a bullish engulfing pattern on a 5-minute time frame. So keeping this in perspective, one has to choose a time frame based on the intended length of the trade. So how do you decide your intended length of your trade? If you are starting out fresh or if you are not a seasoned trader, I would suggest you avoid day trading. Start with trades with an intention to hold the trade for a few days. This is called positional trading or swing trading. An active swing trader usually keeps his trading position open for a few days. The best look-back period for a swing trader is 6 months to 1 year. On the other hand, a scalper is a seasoned day trader. Typically, he uses 1 minute or 5 minutes time frame. Once you are comfortable with holding trades over multiple days, graduate yourself to day trading. My guess is, your transition from a positional trader to a day trader will take some time. Needless to say, for a dedicated and disciplined trader, the transition period is remarkably lesser. 19.3 Look-back period. Look-back period is simply the number of candles you wish to view before taking a trading decision. For instance, a look-back period of 3 months means you are looking at today's candle in the backdrop of at least the recent 3 months data. By doing this, you will develop a perspective on today's price action with reference to last 3 months price action. For swing trading opportunities, what is the ideal look-back period? From my experience, I would suggest that a swing trader should look for at least 6 months to 1 year data. Likewise, a scalper is better off looking at last 5 days data. However, while plotting the S&R levels, you should increase the look-back period to at least 2 years. 19.4 The Opportunity Universe. There are roughly about 6,000 listed stocks in the Bombay Stock Exchange (BSE) and close to about 2,000 listed stocks in the National Stock Exchange (NSE). Does it make sense for you to scan for opportunities across these thousands of stocks on a daily basis? Obviously not. Over a period of time, you need to identify a set of stocks that you are comfortable trading. These set of stocks would constitute your opportunity universe. On a daily basis, you scan your opportunity universe to identify trading opportunities. Here are some pointers to select stocks to build your opportunity universe. Ensure the stock has adequate liquidity. One way to ensure adequate liquidity is to look at the bid-ask spread. The lesser the spread, the more liquid the stock. Alternatively, you can have minimum volume criteria. For example, you can consider only those stocks where the volume per day is at least 500,000. Make sure the stock is in the EQ segment. This is basically because stocks in the EQ segment can be day traded. I agree. I discourage day trading for a newbie. However, in a situation where you initiated a positional trade and the target is achieved the same day, there is no harm in closing the position intraday. This is a bit tricky, but make sure the stock is not operator-driven. Unfortunately, there is no quantifiable method to identify operator-driven stocks. This comes to you by sheer experience. If you find it difficult to find stocks that comply with the above points, I would advise you to simply stick to the Nifty 50 or the Sensex 30 stocks. These are called the index stocks. Index stocks are carefully selected by the exchanges. This selection process ensures they comply with many points, including the ones mentioned above. Keeping Nifty 50 as your opportunity universe is probably a good idea for both swing trader and scalper. 19.5 The Scout. Let us now proceed to understand how one should go about selecting stocks for trading. In other words, we will try and identify a process employing which we can scan for trading opportunities. The process is mainly suited for a swing trader. We have now set the 4 important aspects. The charting software suggests you use 0 as pi. Time frame, end of day data. Opportunity universe, Nifty 50 stocks. Trade type, positional trades with an option to square off intraday, provided the target hits the same day. Look back period, between 6 months to 1 year. Increase to 2 years while plotting the S&R level. Having fixed these important practical aspects, I will now proceed to share my methodology of scanning trading opportunities. I have divided the process into 2 parts. Part 1, the shortlisting process. I look at the chart of all the stocks within my opportunity universe. While looking at the chart, my attention is only on the recent 3 or maximum 4 candles. While looking at the recent 3 candles, I check if there is any recognizable candlestick pattern being developed. If I find an interesting pattern, I shortlist the stock for further investigation and I continue the scouting process. I always ensure I check all the 50 charts. Part 2, the evaluation process. At this stage, I am usually left with 4 to 5 shortlisted stocks out of the 50 stocks in my opportunity universe, which exhibit a recognizable candlestick pattern. I then proceed to evaluate these 4 to 5 charts in detail. Typically, I spend at least 15 to 20 minutes on each chart. Here is what I do when looking at the shortlisted chart. I generally look at how strong the pattern is. I am specifically interested in checking if there is any need for me to be more flexible. For example, if a bullish Marubozu has a shadow, I evaluate the length of the shadow with reference to the range. After this, I look at the prior trend. For all bullish patterns, the prior trend should be a downtrend. And for all bearish patterns, the prior trend should be an uptrend. I do pay a lot of attention to prior trends. At this stage, if everything looks good, i.e., I have identified a recognizable pattern with a well-defined prior trend, I proceed to inspect the chart further. After this, I look at the volumes. The volume should be at least equal to or more than the 10-day average volume, provided both the candlestick pattern and volumes confirm. I then proceed to check the existence of the support in case of a long trade and resistance in case of a short trade level. The S&R level should coincide as much as possible with the stop loss of the trade as defined by the candlestick pattern. If the S&R level is more than 4% away from the stop loss, I stop evaluating the chart further and proceed to the next chart. I then look for doubt patterns, particularly for double and triple top and bottom formations, flags formations, and the possibility of a range breakout. Needless to say, I'd also establish the primary and secondary market trend. If the steps 1 to 5 are satisfactory, I proceed to calculate the risk-to-reward ratio, RRR. To calculate RRR, I first establish the target by plotting either the support or resistance level. The minimum RRR should be at least 1.5. At last, I look at the MACD and RSI indicators to get a perspective. If they confirm and if I have spare cash, I increase my trade size, usually out of the 4 to 5 short-listed stocks. At the most, 1 or the 2nd of May qualify for a trade. There are days when there are no trading opportunities. Deciding not to trade in itself is a big trading decision. Do remember, this is a fairly stringent checklist. If a stock is confirming to the checklist, my conviction to trade is very high. I have mentioned this many times in this module. I will mention this for one last time. Once you place a trade, do nothing till either your target is achieved or stop loss is triggered. Of course, you can trail your stop loss, which is a healthy practice, but otherwise do nothing. If your trade complies with the checklist, and do remember, the trade is highly curated, hence the chance of being successful is high. So it makes sense to stay put with conviction. 19.5 The scalper. For a seasoned swing trader, scalping is another option. Scalping is a technique where the trader initiates a fairly large trade with an intention of holding the trade for a few minutes. Here is a typical example of the trade done by a scalper. First leg of the trade, second leg of the trade. Time 10:15 a.m. Time 10:25 a.m. Stock Infosys. Price 3,980. Price 3,976. Action, sell action, buy. Quantity 1,000 shares. Quantity 1,000 shares. Overall profit after applicable charges equals 2,653 rupees per. Denote. The overall profit is calculated considering that you are trading with Zerodha. The overall profitability would shrink remarkably if you are scalping with inexpensive brokerage rates. Containing transaction charges is one of the keys to successful scalping. A scalper is a highly focused trader with a sharp sense for price. He utilizes highly precise charts such with 1-minute and 5-minute time frame to make his trading decisions. A successful scalper executes many such trades within the day. His objective is simple: large quantity trade with an intention to hold for a few minutes. He intends to profit from the small moves in the stock. If you aspire to be a scalper, here are a few guidelines. Do remember the checklist we have mentioned, but do not expect all the checklist items to comply, as the trade duration is very low. If I were to handpick just 1 or 2 items in the checklist for scalping, it would be candlestick pattern and volume. A risk-reward ratio of even 0.5 to 0.75 is acceptable while scalping. Scalping should be done only on liquid stocks. Have an effective risk management system. Be really quick to book a loss if need be. Keep a tab on the bid-ask spread to see how the volumes are building. Keep a tab on global markets. For example, if there is a sudden drop in the Hang Seng, Hong Kong Stock Exchange, it invariably leads to a sudden drop in local markets. Choose a low-cost broker to ensure your costs are controlled. Use margins effectively. Do not over-leverage. Have a reliable intraday charting software. If you sense the day is going wrong, stop trading and move away from your terminal. Scalping as a day trading technique requires a great presence of mind and a machine-like approach. A successful scalper embraces volatility and is indifferent to market swings. Key takeaways from this chapter. If you aspire to become a technical trader, ensure you equip yourself with good charting software. Zerodha's Pi is my preference. Choose EOD chart for both day trading and swing trading. Look at intraday charts if you like scalping the markets. The look-back period should be at least 6 months to 1 year for swing trading. Nifty 50 is a great opportunity universe to begin with. The opportunity scanning can be done in 2 parts. Part 1 involves skimming through the charts of all the stocks in opportunity universe in short, listing those charts that display a recognizable candlestick pattern. Part 2 involves investigating the short-listed charts to figure out if they comply with the checklist. Scalping is advisable for seasoned swing traders. 374 responses to the finale, helping you get started. Open a Zerodha account. Chapter 20. Supplementary Notes 1. Average Directional Index, ADX. About. The average directional index, ADX, minus directional indicator, DI, and plus directional indicator, plus DI, represent a group of directional movement indicators that form a trading system developed by Wells Wilder. The average directional index, ADX, measures trend strength without regard to trend direction. The other 2 indicators, plus directional indicator, plus DI, and minus directional indicator, DI, complement ADX by defining trend direction. Used together, chartists can determine both the direction and strength of the trend. Source: StockCharts.com. What should you know? ADX system has 3 components: ADX, plus DI, and DI. ADX is used to measure the strength-weakness of the trend and not the actual direction. ADX above 25 indicates that the present trend is strong. ADX below 20 suggests that the trend lacks strength. ADX between 20 and 25 is a gray area. A buy signal is generated when ADX is 25 and the plus die crosses over die. A sell signal is generated when ADX is 25 and the die crosses over plus die. Once the buy or sell signal is generated, take the trade by defining the stop loss. The stop loss is usually the low of the signal candle for buy signals and the high of the signal candles for short signals. The trade stays valid till the stop loss is breached, even if the plus die and die reverses the crossover. The default look-back period for ADX is 14 days. On Kite, load the ADX indicator from studies. Kite gives you an option to change the look-back period. By default, the look-back period is set. You can customize the color of all the three components of the ADX system. Click on Create to load the indicator. By default, the ADX indicator is loaded below the instrument. The black line represents ADX. Ensure it is above 25 while looking for the crossovers. Alligator indicator. About. An indicator designed to signal a trend absence. Formation and direction. Bill Williams saw the alligator's behavior as an allegory of the market's one. The resting phase is turning into the price hunting as the alligator awakes so that to come back to sleep after the feeding is over. The longer the alligator is sleeping, the hungrier it gets and the stronger the market move will be. Source: Infomarkets.com. What should you know? The alligator indicator is overlaid on the price chart. The indicator is made up of three simple moving averages. 13, 8, and 5 period averages are used. The 13 period MA refers to the alligator's GIA. 8 period MA refers to the alligator's teeth. And the 5 period MA refers to the alligator's lips. By default, 13 megaamperes is colored blue. 8 megaamperes is colored red. And 5 megaamperes is colored green. A buy signal is generated when the following condition is satisfied. All three MAs are separated. The price is above the 5 megaamperes. 5 megaamperes is above 8 megaamperes. And 8 megaamperes is above 13 megaamperes. Once the above condition is satisfied, it means that the asset is trending up. When the uptrend is established, it is up to the trader to identify a good entry point within this trend. A sell signal is generated when the following condition is satisfied. All three MAs are separated. The price is below the 5 megaamperes. 5 megaamperes is below 8 megaamperes. And 8 megaamperes is below 13 megaamperes. Once the above condition is satisfied, it means that the asset is trending down. When the downtrend is established, it is up to the trader to identify a good entry point within this trend. Periods when the 13, 8, and 5 megaamperes are intervened or moving flat is considered no trader zone, and therefore the trader is advised to stay out of markets. On Kite, load the alligator indicator from the studies. As you can see, the default values of the moving averages are loaded, i.e. 13, 8, and 5. As you can see, the indicator input also loads the offset values for each MA. These offset values are also loaded by default values. Offsetting or displacing the moving average reduces the number of whipsaws in the average. Needless to say that you can change the default values for moving average and offset to any value that you deem appropriate. Further, you can even customize the color of each indicator to your preference. Here is the snapshot of how the indicator looks when the indicator is overlaid on the chart. Do notice there are two instances when the sell condition is satisfied, highlighted in red, and one instance when the buy condition is satisfied, highlighted in blue. Arun. About. Developed by Tu Sharchand in 1995. Arun is an indicator system that determines whether a stock is trending or not and how strong the trend is. Arun means dawn's early light in Sanskrit. Chand chose this name because the indicators are designed to reveal the beginning of a new trend. The Arun indicators measure the number of periods since price recorded a next day high or low. There are two separate indicators, Arun up and Arun down. A 25-day Arun up measures the number of days since a 25-day high. A 25-day Arun down measures the number of days since a 25-day low. In this sense, The Arun indicators are quite different from typical momentum oscillators, which focus on price relative to time. Arun is unique because it focuses on time relative to price. Chartists can use the Arun indicators to spot emerging trends, identify consolidations, define correction periods, and anticipate reversals. Source: StockCharts.com. What should you know? The indicator measures the number of days since last high or low is made. Hence, the indicator is a measure of time relative to the price. Arun consists of two components, Arun up and Arun down. The default value for Arun is 25 days. Arun up measures the number of days since the last 25-day high occurred, and Arun down measures the number of days since the last 25 days low has occurred. Both Arun up and Arun down are plotted side by side. Arun up down is lower bound to 0 and upper bound to 100. A buy is generated when Arun up is above 50 and Arun low is below 30. A sell is generated when Arun down is above 50 and Arun up is below 30. On Kite. Here is the snapshot of the indicator when loaded from studies. As you can see, the default period is 14. Feel free to change this to any number you wish. 14 here represent the number of days. Do remember, if the period is 14, the Arun measures the number of days since the stock made 14 days high, low. As you can see, both Arun up and Arun down are plotted. Arun oscillator. Arun oscillator is an extension of the Arun indicator. The Arun oscillator measures the difference between the Arun up and Arun down and plots the difference in the form of an oscillator. The oscillator swings between -100 to +100, with the 0 level as the center point. The snapshot below shows the Arun oscillator loaded onto the chart. A reading above 0 means that Arun up is greater than Arun down, which implies that prices are making new highs more recently than new lows. Conversely, readings below 0 indicate that Arun down is greater than Arun up. This implies that prices are recording new lows more recently than new highs. As you can see, the Arun oscillator is either going to be positive or negative the vast majority of the time. This makes interpretation straightforward. Time and price favor an uptrend when the indicator is positive and a downtrend when the indicator is negative. A positive or negative threshold can be used to define the strength of the trend. For example, a surge above +50 would reflect a strong upside move, while a plunge below -50 would indicate a strong downside move. Source: StockCharts.com. Average True Range. About. Developed by J. Wells Wilder. The average true range (ATR) is an indicator that measures volatility. As with most of his indicators, Wilder designed ATR with commodities and daily prices in mind. Commodities are frequently more volatile than stocks. They are often subject to gaps and limit moves, which occur when a commodity opens up or down its maximum allowed move for the session. A volatility formula based only on the high-low range would fail to capture volatility from gap or limit moves. Wilder created average true range to capture this missing volatility. It is important to remember that ATR does not provide an indication of price direction, just volatility. Source: StockCharts.com. What should you know? Average true range (ATR) is an extension of true range concept. ATR is not upper or lower bound, hence can take any value. ATR is stock price specific. Hence, for stock 1 ATR can be in the range of 1.2 and stock 2 ATR could be in the range of 150. ATR attempts to measure the volatility situation and not really the direction of the prices. ATR is used to identify stop loss as well. If the ATR of a stock is 48, then it means that on average the stock is likely to move 48 points either ways up or down. You can add this to the current day's range to estimate the day's range. For example, the stock price is $13.20. Then the stock is likely to trade between $13.20 to 48 equals $12.72 and $13.20 plus 48 equals $13.68. If the ATR for the next day decreases to say 40, then it means that the volatility is decreasing, and so is the expected range for the day. It is best to use a TR to identify the volatility-based SL while trading. Assume you have initiated a long trade on the stock at $13.25. Then your SL should be at least $12.72 or below since the ATR is 48. Likewise, if you have initiated a short at $13.20, then your stop loss should be at least $13.68 or above. If these SL levels are outside your risk to reward appetite, it's best to avoid such trade. On Kite, as you can see, the default value of ATR is 14, which means to say that the system calculates the ATR for the last 14 days. Of course, you can change this to any value to wish. Here is the snapshot. Once you load the chart, ATR is plotted below the price chart as seen below. So the next time you place a stop loss, make sure you check the ATR value to see if stop loss level is relevant. You may also want to read more about volatility and its application, including volatility-based SL. Click here. Average True Range Band. The ATR bands are an extension of the ATR concept. The idea is to plot an envelope around the stock price to evaluate if the stock prices are behaving normally or trending in a particular direction. In order to do this, the ATR band calculates the upper and lower band. What should you know? The ATR band calculates and plots the upper and lower envelope around the stock price. To begin with, the moving average of stock prices calculated. The ATR value is added to the moving average value, and this forms the upper envelope. The ATR value is subtracted to the moving average value, and this forms the lower envelope. If the stock price penetrates either the upper or lower envelope, then the expectation is that the stock price will continue to move in the same direction. For example, if the stock price has penetrated above the upper envelope, the expectation is that the stock will continue to move higher. You can even use the ATR bands as an alternate to the Bollinger Band trading system. You can read more about the Bollinger Band, section 15.2. On Kite. When you load the ATR band from studies, you will be prompted for few inputs. Period refers to the MA time frame. The default value is 5 days. You can change this to whichever time frame that you deem suitable. We would suggest you ignore shift parameter. For the field option, select close. This means to say that you are plotting the MA values on the closing prices. The rest of the options are mainly aesthetic features. Feel free to explore them. Once you click Create, you will see the ATR bands plotted on the chart. Supertrend. Before understanding the supertrend indicator, understanding the ATR is necessary as supertrend employs ATR values to calculate the indicator values. The supertrend indicator is plotted over the price chart of the stock or the index. The indicator line changes its color between green and red based on the price movement in the underlying. Supertrend does not predict the direction. Rather, once the direction is established, it will guide you to initiate a position and suggests you to stay in the position till the trend sustains. What should you know? When plotted, the supertrend indicator appears like a alternating green and red continuous line. A buy signal is generated when the stock index price turns greater than the indicator value. At this stage, the indicator color turned green and you can also see a crossover of the price versus the indicator price greater than indicator value. Once the long position has been established, the trader is advised to hold the position till the price closes below the green line. So in a sense, the green line helps as a trailing stop loss for the long position. A sell signal is generated when the stock index price turns lesser than the indicator value. At this stage, the indicator color turn red and you can also see a crossover of the price versus the indicator price lesser than indicator value. The sell signal can be used to initiate a fresh short or exit long. Although waiting for the sell signal to exit the existing long position can sometimes lead to taking a loss. So the trader should use his discretion here. Once the short position has been established, the trader is advised to hold the position till the price closes below the green line. So in a sense, the red line helps as a trailing stop loss for the short position. Supertrend is basically used to identify a trend, therefore it works best in a trending market. The super trend indicator, when compared to a regular moving average trading system, generates fewer false signals. For this reason, the super trend indicator is preferred over a moving average trading system. On Kite, when you select super trend indicator from the list of studies, you will be prompted for two inputs: period and multiplier. Period refers to the ATR number of days. The default value on Kite is 7, which means to say that the system will calculate the ATR value for the last 7 days. You can input any value you deem suitable. The multiplier refers to a value by which the ATR will get multiplied. The default value on Kite is 3. So whatever is the value of ATR, it will get multiplied by 3. Multiplier is a crucial input for Supertrend. If the multiplier value is too high, then lesser number of signals are generated. Likewise, if the multiplier value is too small, then the frequency of signals increase. Hence, chances of generating false trading signals are quite high. I would suggest you keep this value between 3 and 4. Once the indicator is plotted, this is how it appears on the chart. Notice how the indicator changes the color as the price moves. Also, whenever the buy-sell signal is generated, green and red arrows are generated, respectively, prompting the trader to go long or short on this stock. Volume weighted average price, VWAP. VWAP is one of the simplest indicators to use. It works on the principle of averaging the traded price in terms of volume traded. Let me give you an example to help you understand this better. Here is how NFI traded between 14:30 and 14:35 on the 2nd of November 2016. The data is quite simple to understand. For example, at 14:32, 2,475 shares were traded. It made a high of 983.95, low of 983, and closed the minute at 983.1. Now, we use this data and compute the VWAP price. In order to do this, we calculate the following. Typical price equals, which is the average price of high, low, and close. Volume price, VP, equals, we get this by multiplying the typical price with its volume. Total VP equals, this is a cumulative number, which is got by adding the current VP to the previous VP. Total volume equals, this is again a cumulative number, which is got by adding the current volume to the previous volume. VWAP equals, we get this VWAP number by dividing the total VP by total volume. The resulting number indicates the average traded price, weighted by volume. Let's do the math on NFI data. As you see, the VWAP is a dynamic number, changing based on how the trades flow in. How to use the VWAP? VWAP is an intraday indicator. Use it on minute charts. Often when you plot this, you will notice a jump at 9:15 a.m. when compared to previous day's data. Ignore this jump as it means nothing. VWAP is an average, and like any indicators employing averages, this too lags the current market price. VWAP is used for two main reasons: to get a sense of intraday direction and to get a sense of the efficiency of order execution. If the current price is below VWAP, then the general opinion is that the intraday trend is down. If the current price is above VWAP, then the general opinion is that the stock is trending higher. If the VWAP lies in between the high and low, then the expectation is that the stock will remain volatile. If you intend to short a stock, then it is considered an efficient fill if you short the stock at a price higher than VWAP. Likewise, if you intend to go long on a stock, then it is considered an efficient fill if you go long at a price lower than VWAP. On Kite, open the chart of your preference and select VWAP from the Studies drop-down. Note: VWAP can be applied only on intraday time frame and cannot be applied on EOD data. Once you select the time frame 1 minute, 5 minutes, 10 minutes, etc., the engine calculates the VWAP and plots it on the chart as an overlay. You can now visualize the VWAP and the current market price and plan your trades accordingly. 205 responses to Supplementary Notes 1. Adam, February 25th. 2016 at 9.